The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
Welcome back to another edition of Daily Dots here on Monday, June 9th in a hot Tacoma, Washington for once. Mid to high 80s today, that's an event here, just so you know. So I'm going to go through and flying solo with you. If you remember from last week, I'll be with you by myself today, tomorrow, and Wednesday. Zach is on the road. It's about 10 minutes before the close, so I'm going to go through some other stuff, and then I'll kind of close up with the numbers instead of opening there. In the news today, I think the most important thing was the U.S.-China talks in London. This is interesting for a host of reasons. It sounds like what is developing right now is assurances that, yes, those rare earths are very much on the way, in exchange for backing off on some export controls from the U.S. side. Now, the reason I find this interesting is because the last deal, the last round of negotiations, was said to have included rare earths. So we gave something up, lowering tariffs, to get rare earths as one of the main reasons, reportedly the main reason. They clearly slow played that. So I find it awkward that we got that in return last time, but now it sounds like we're getting it in return this time. So like we gave some stuff up for it. They didn't do it. So we're giving more stuff up for it. I don't know. None of us really know what's going on, in reality, but it sounds like when it comes to export controls on things to include nuclear material, jet engines, obviously some technology and semiconductors, though they made it clear, like not the highest end stuff. We're going to ease export controls on those things. Even though it's not going to be on the highest end AI chips, this still could be a big deal for TSMC, for NVIDIA, which you kind of see in the market a little bit lately. But I think more broadly speaking, this does show like that my hunch this year has been right, that the reality is China has more leverage than we do, despite the fact that in a lot of ways, it seems like we should be the ones with leverage. I think you just get to a point where when what you're good at is shuffling paper, essentially, and what the other people are good at is making very important, real industrial things. Leverage at that point, you can throw the calculator out. Like, what matters is who makes real stuff, especially when it's really critical, important, real stuff that can break entire supply chains. So whenever automobile manufacturing plants have to shut down because they don't have enough rare earths, that becomes a very big deal compared to what we can pull back from them or throw tariffs on them. Like all we're doing is kind of shooting ourselves in the foot along those lines. With that said, hopefully these negotiations can continue and it can be win-win. Hopefully both sides can get things they need without, I think China and the US can have a strategic rivalry, a competition without this spiraling out of control, getting to the point where, we don't work together. Because at the end of the day, we need their stuff because they're really good at making stuff. And, they could use our capital. They could use a lot of our intellectual capital that we still have. It just makes sense for the two sides to trade. They could use our consumer, obviously. Like they have done a great job of expanding their trade with the rest of the world, but we're still an enormous consumption market. They export a lot of stuff here. So the two sides may not agree on much, but they absolutely need each other. So it's gonna be interesting to follow this as we go. But at the moment, it looks like we're just pulling off the things that we put on for the last 3-4 months, and they're just kind of doing the same thing, which makes me wonder what was the point of putting all this stuff on to begin with? But I don't know. I think there's just miscalculation there, and now we're just kind of seeing the consequences of it live. As far as data goes this week, today, not much. We will have CPI on Wednesday. It's kind of the big one for the week. Expected to be 0.2 on the month over month, about 2.5% on the year over year. I wouldn't be surprised if it came in at 2.4. So still above the mandate on inflation, but very cool lately, which brings up kind of a separate point that I wanted to mention real quick. And I was just thinking about this earlier today, and that is emerging markets have had a good time of it this year, which has been very helpful for us in some of our investments. Places like China, Greece, that we've had some money this year. South Korea. One of the reasons they've had a good time of it, and the one that everyone focuses on, is the dollar's down a lot. It's having kind of the worst start to a year in forever. And that's clearly no doubt true. But at the same time, I think really weak oil prices they've done a lot for the emerging world. The emerging world, it's hard to have a better cocktail than dollar down, oil down. And then you can even throw on the kicker of China's exporting so much deflation that, you have all just three like kind of disinflationary like impulses that allow a lot of rate cuts in EM that they normally don't really get to have, which obviously is very good for their equity multiples. So as long as oil can stay down, and to be clear, like if you look at the front month chart, it's breaking higher. No two ways about it. And that's kind of what put this top of mind. So, but point being, if you can keep oil, under 70 or whatever, maybe even, sub 60, sub 50 in a more extreme scenario, the rest of this year, or even into next year, if that doesn't come with a lot of like really bad growth problems, that becomes just a massive catalyst to kind of extend this run we're on in non-US, specifically EM equities. But the flip side of that, if oil, for whatever reason, this front month breakout is real in a way that's just hard to understand at the moment, maybe US oil production really is about to roll over in a meaningful way, as the only kind of way I can really imagine this. If that were to happen, let's say oil ends up $15 higher from here to close out the year, kind of does the opposite, like especially if it were to bring the dollar with it, which I'm not saying it would, but if you have the dollar or the oil like $15 higher, that inflationary impulse globally starts to pick back up. These rate cuts that we've had that have really helped a lot of other countries. Obviously, we're just sitting on our rate and we haven't changed it in a while. But you look around the world, places Latin America, Asia, like they're slashing rates, Africa even. One of the things that kind of made this top of mind today was Mexico has done, I think, 3 straight 50 basis point cuts. And now all of a sudden their inflation rates kind of pick back up above their mandate. And that's with oil, doing nothing. So it made me realize, just using Mexico as a proxy. Okay, well, if oil rips $5, $10, $20, those rate cuts are over. And when everyone thought they could continue, it just makes things interesting. Or if I look at a Brazil who, their central bank finally started to get confident, like, all right, maybe we're done hiking, because they've been hiking aggressively. Well, if oil goes up $10 from here, like you're definitely not done hiking. So just something to kind of keep in mind. And for us, as we have, a few non-US investments we really like, being careful with oil. And obviously it's not like oil jumping $10, $20 or whatever would just go easy on the US, because it wouldn't. With wages falling, to have oil go up would squeeze real incomes, squeeze consumption of other things, could become, its own problem. Claims will be Thursday. They're every Thursday, but jobless claims are going to be a big deal this week. We've had 2 or 3 kind of in a row that are a little warm, like a little unnerving. Yellow flag, not red flag, but yellow flag. So I'm putting a little more weight on that Thursday than normal. 5:30 in the morning here, West Coast. I will make sure I'm ready for that. And 2 other things I wanted to talk about quick, and then I'll recap the markets and get out of here. And that is the late summer setup. I can't remember if I've talked about this on the show or not, but it's been clear to me the last few weeks, if not month or 2. Yeah, not month or 2. That's too aggressive. The last few weeks, that the U.S. equity market was going to be in good shape, going to be fine. not really a bear market rally. Like the market's just fine. Mostly because you got vol down enough to kind of re-engage the all the automatic buying. Obviously the passive never went away. It's there. That's a very strong force. But more to the point, CTAs, vol control funds, all the other systematic strategies, momentum, you name it. Like they got into a place where it could buy and keep buying. And as I've outlined on the show, like vol control has only been buying really the last couple weeks. So you're talking, roughly speaking, a few $1 billion every day for CTAs, vol control to get in there and buy some more. You've had vol just melting. Options dealers have been in positive gamma for a while now. And I just think if I kind of look at the calendar, we know whenever the big, beautiful bill finally passes and the president signs it, that's when they have to refill the TGA, which is liquidity drain. That in itself is a headwind for the equity market. If you get that, and you could pair it with, getting some negative gamma to where vol moving higher could lead to vol moving higher. Equity selling could lead to more equity selling. You get that reinforcing loop. You could have sort of a fundamental reason with the TGA getting refilled, the liquidity draw, and the systematic, the market structure reason of having those dealers kind of unpin, allowing for the bigger moves, and then having the chase to the downside. So I think that'll be roughly late summer. We're close to mid-June now. Pretty clear we're not super close on getting this bill through Congress. I would say mid-July at the earliest, probably. More likely sometime August, September. Whenever that thing happens, that's when I think you start getting a little more cautious and start looking at hedges harder. And the last thing I want to talk about, which I've definitely talked about before, I just kind of want to reiterate, it's front of mind, stays front of mind for me. This is a slower moving, bigger picture thing, but that is the trade war potentially becoming a capital war. The more I read, the more I think, the more I read history, the more it kind of becomes clear to me that if we press our luck in any meaningful way, geopolitically and with trade, that global capital could find its way out of the U.S. in a more meaningful way. And I really do not think the average investor even realizes that. But even if they do, I don't think they recognize the magnitude of the move. Way I kind of explained it the other day to some clients was it could be kind of like trying to unload a super tanker into a kiddie pool. Like the rest of the world's ability to handle the size of the potential outflows, if they were to happen in a more sped up pace than we saw earlier this year, it just, the significance of that is pretty difficult to overstate. And this doesn't even take, this is an important part. Like it doesn't even necessarily take some sort of big, geopolitical fight or like nasty trade war. Some of this is just kind of baked in the cake. If you look at Japan, a lot of money's finding its way back to Japan. Japanese people are putting less money overseas, and that's not for some big fancy reason. It's just because they had to take their money out of Japan and put it elsewhere to get a yield. Well, now they have inflation and their bond yields are going a lot higher. They're going to have to keep raising rates. So now there's a yield in Japan. So if you're a Japanese investor and you've had your money parked overseas for the last 20 years because you had to get a return, now you don't. You can bring your money home and get a return. And you probably are going to return on the currency. You can probably going to get a nice return on going out on the curve in the sovereign bond market. And you're going to get a return on equities. Like there's not much point in going and buying French or US or, Australian government bonds whenever you can just bring the money home. There's no point in buying the Qs whenever you can put money into some of the great companies in Japan. And that's one example. It has nothing to do really with politics, right? And then there's a bunch of other examples that have everything to do with politics, mostly Europe. Europe has an insane amount of money invested in the US. They have a lot of needs for their own capital in Europe. So they're probably going to get some of their capital back. Some voluntarily, some could end up becoming, like a nudge, or even just pure force of like, you got to go do it. Or, carrots, like, hey, no taxes if you bring your money back, things like that. So all things to keep in mind. I know I've talked about that a lot, and it's really, really big picture, slow moving stuff, but it's my focus. I can't stop thinking about it. It's too big of a deal. It's too big of a thing that we're just not used to dealing with. That has enormous ramifications. So something to keep in mind. All right, to the markets. S&P closed the day up 0.09. I think the rest of the week is pretty much going to go this way until we have options expiration. This pin right around 6,000 is probably going to hold. You might have some days, 1% above, 1% below, but I think you're going to end the week pretty close to 6,000. The NASDAQ up 0.15. The small caps were up 0.66. Equal weight flat. Mag 7 up about 1%. You had all world ex-US up 0.23, so very minor outperformance there. You had oil up 1.13, and as I mentioned, like you go to front month, that's a nice breakout, a nice technical move. One that difficult for me to rectify with the fundamentals, but the chart's the chart. It looks good. Gold was flat. Silver up another 2%, and you're up to almost $37 on silver now. Platinum up another 4.5%, and palladium up 3%. Silver and platinum group metals have had a really nice run the last 2 weeks. Starts to get interesting to see, how far they can go before they have to do a pullback. How straight down will the pullback be since we've gone straight up? It's going to be difficult to trade for people that are involved in these. Copper up about 1%, a little over. That looks like it may be trying to go back to its breakout level. Good day for Bitcoin, up almost 3%, up back above 108,000. Dollar down another 0.23. Not a new low yet. You're still kind of just going sideways here the last couple of weeks. Getting below kind of like 98.40. That's when you're kind of into ugly territory. Like looks like you could, quickly move to ugly new lows. As far as bonds go, the 2-year was down about 3 basis points. Same for the 10-year. So the whole curve kind of down 3-ish, less out on the 30-year, but. And then vol down another kind of 1.6% on vol futures. So you're at 18.23. Kind of go back to that late summer setup I talked about, which obviously anytime you start forecasting some, well thought out way things are going to go 2 months in the future, like the chances of it happening the way I'm envisioning are very small. But if that were to play out, I could see this front month vol being down to like 16, 15. Late summer, just kind of gone to sleep, and that will just be a really good opportunity if we can get there and get that set up, the way I'm kind of envisioning it. And one last thing, U.S. markets kind of flat on the day, and Chinese equities up another 2+% today. So to go back to the talks in London, since this kind of latest round of talks between the U.S. and China. We kind of had we'll bring the tariffs down one, and the U.S. outperformed China, which I found a little interesting and counterintuitive. But since we've had this kind of second round open up, it's definitely been Chinese markets really leading the way versus the U.S. So as the week rolls on with the talks between the two sides, it'll be interesting to see how U.S. versus China markets kind of continue to operate. That's it for me today. I'll be back with you tomorrow and Wednesday alone. And then I think Zach will be with us for the last couple of days of the week. But that's it for now. Have a good one. Cheers.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.